Renovating Retirement with Charlie Jewett. Oh no, I think I'm about to have another episode.
They say you want accumulation, well, you know.
Testing, 1, 2, 3, this industry is mad at me. Hey everybody, welcome back to the Renovating Retirement Podcast with Charlie Jewett and my group of chipmunk friends or whoever is here. And sometimes Mr. T. I'll pity the fool that listens to the Joker Broker. This is episode 131. 131 episodes, can't believe it. Second episode in a 4-part series called The 4 Stages of Retirement Planning, which are contribution, accumulation, distribution, and transfer. Another way of saying that is you got to save the money. You got to let it grow. Then it has to pay you. You got to take an income. You got to distribute it into your pocket so you can live during retirement. And then, once you pass away, it has to transfer, and maybe you don't care where it goes, and that's fine, because that's the easiest transfer plan is I don't care. But today we're talking about Part 2, the 4 Stages of Retirement Planning, Part 2, which is accumulation, accumulating, letting the money grow, okay? So first and foremost, I want you to understand and truly understand compound interest, because the stock market does not give you compound interest. It gives you capital gains. So the most popular tool on the planet for trying to compound and grow money doesn't give compound interest. It could be compounding, it could be getting bigger, and that's called capital gains, but it's not true compound interest where you're earning interest on interest on interest on interest. And to do that, I'm going to go to one of my nerdy spreadsheets where I sat up one time and said, what are all the different ways that somebody could earn 8% per year average rate of return for 30 years? You can't see the spreadsheet, so I'll describe it. And if you want it, you can email me at charlie@jewettwealth.com, CHARLIE @JEWETTwealth.com, and you can say, can I have that nerdy spreadsheet so I can stay up in the middle of the night looking at numbers like you and not sleep and have my girlfriend get mad at me? And I'll say, sure, it's the best life imaginable. The way that you could earn interest and end up with the highest amount of money at the end, this is why I have a problem with what the brokers teach and what the financial planning software shows you. The best, number one, best possible way to earn 8% would be to earn 8% straight every year for 30 years. So on my spreadsheet, I've got, column A says years 1 through 30. Right next to it, column B says 8%, 8%, 8%, 8%, 8%. Just says the same thing as if you were purchasing a CD for 8%, or, a 30-year fixed annuity, which doesn't even exist, for exactly 8%. So when you look at column C, you start with $100,000. Well, after making 8%, it turns into $108,000. The next year, making 8%, turns into $116,640, and it's compounding, $125,971. Well, what do we end up with? After 30 years of 8% compound interest, we end up with $1,006,000 roughly, basically $1 million. And that's awesome. The problem is, that's what your Joker Broker is showing you that you're going to have when you're working backwards to decide how much you should be saving, and is it safe to take market risk. The problem is that's what retirement planning software is showing you. But unfortunately, that's not the way the world works if you're using anything that can go below zero. As soon as you have either fees or losses, something that can go below zero, the math gets really squirrely, and every single of the infinite ways you could be averaging any percentage, I'm using 8%, of the infinite ways you could average any percentage over 30 years and say, my broker did his job, and he actually made me 8% or 9% or 10% for the whole 30 years, does not mean you're going to end up with enough money to retire, because there's an infinite number of different account values from 0 up to 1,006,000 that you could end up with averaging 8%. So the columns that I have, there's tons of them going across to the right, say, well, what if I made 7% one year, 9% the next year, 7% the next year, 9% the next year, and I'm alternating. And then I go, what if I made 6 and 10 and 6 and 10 and 6 and 10, 5 and 11, 5 and 11, and then I get into some negative things. I keep going to the right, yada, yada, yada. This is what geeks do in the middle of the night. Let's see here. This is what geeks do on Sundays. Look at their spreadsheets and do podcasts. Christmas is so far gone, but I just felt the need to do that. I do not know why. All right, back to the spreadsheet. We've got one here. I'm trying to look for one that ends up with half the account value of making 8%. That would be interesting to me to see. My spreadsheet has so many columns, I just got lost. So have patience. There it is. Found it. I'm back home. So let's find one here where instead of ending up with $1 million, we end up with, you know, 500,000 bucks or something like that. So let me spread all the way across here. Close enough. So if the market were to go down 12%, so as soon as you put in 100 grand, it went down 12%, and then it rallied and went up 28%. Woohoo, baby! Down 12. Darn it all. Goes up 28. Woohoo, baby! Darn it all. Woohoo! Down. Go up and down, right? Down 12, up 28. Down 12, up 28. Down 12, up 28 for 30 years. You add them all up, that's 240%, just like 8 times 30. And but you look at the column where you're compounding, and because of all those losses, going down 12% on a big number, going up 20% now on a lower number, you only end up with $596,000, almost half of that $1 million that you deserve. And what I'm telling you, I've been preaching it over and over and over again. What I am telling you, if you let your money go below zero, you can count on absolutely nothing. Some doofus comes along and says the 210-year average for the stock market is 7.1. Or over every 10-year period, the stock market is positive. So you should put money in the stock market so I could play golf. Guys, that doesn't mean anything about how much money you're actually going to end up with. You can't spend an average. You can only spend money. Now, I want you to hear this. All of the positive ones. Remember I said 8% every year for 30 years, or 7 and 9% alternating, or 6 and 10% alternating, or 5 and 11% alternating, or 12 and 4, 13 and 3. All the positive ones. Before we get to the negative one. The first negative one is -1, then positive 17. I want you to hear all of these positive ones, what your account balance would be. 926 is the worst. That's making 0 every other year and making 16 the years in between. 944, making 1, 15, then 1, then 15, then 1. I'm just going to go right across the board here. 960, 974. So the worst one, if you don't let it go below 0, the worst one, 926. Or the best one, making 8% straight for 30 years, is $1 million. Well, the difference between $1 million and 926, that's not going to make or break your retirement. That's like go out to eat a little less. That's not bad. The issue is when you get below 0, when you start letting yourself take losses. Because from that 926, the very next year goes to 906, go a couple years over, 808, 721, 596. I stopped there because I got tired of doing it. I can tell you, you can average 8% for 30 years and end up with an account with $0 in it. And your broker's allowed to show you a statement that says they made you 8% the entire time. And I'm going to give you an example of that towards the end of the show. So the very first thing I want you to understand is that when you have losses, that's not compound interest. That's capital gains. That's did you make money or not. I want your money compounding. Compound interest is the 8th wonder of the world. Compounding at 4 or 5% might beat somebody who's averaging 14 and going out and playing golf with their joker broker and high-fiving. You may end up with more money averaging 4 or 5 with no fees or low fees, okay? So what is it, what should we be doing here when we're trying to accumulate money? Well, in the contribution piece of this, the previous podcast, I said, you've got to contribute money. You got to spend less than you earn and put money in. So if you want more money, you could always just double your contributions. And I did the math, and if you have 30 years and you're making 6% and you're putting in $500 a month and you put in $1,000 a month instead of $500, you end up with exactly twice as much money. The math makes sense if you double your contributions. But what happens if you can find a way to double your interest earnings, or possibly eliminate fees, or turn your average fake rate of return into a true rate of return, and it doubles your effective rate that you're earning? Well, let's just go to our trusty, dandy future value calculator. So I typed future value calculator in Google. I like the one from calculator.net. It's become my friend. Aw, hello, my friend. I love you. It's nice to see you again today. So weird. And I put in 30 periods. So it says number of periods. I put 30 for 30 years. Starting amount 0. Let's pretend somebody's starting their career, or they've never started saving. They started late. Maybe you're not a child. Maybe you're 40, but you said I never saved, so I got to work till I'm 70 and save for 30 years. Let's just say 3% interest, because I want to prove a point here. 3% interest. By the way, there's a lot of people, a whole lot of people, that actually made 3% interest from the year 2000 to the year 2018. If you haven't listened to the episodes, what do I call them? 3 calculations you must do, I think it was. Yeah, 3 calculations you must do. There's a lot of people that were in some sort of a portfolio that made between 4 and 5. And then when you look at the fees and the dividends they weren't getting, they averaged about 3 for 18 years. So 30 years, so 30 periods, starting amount 0, interest rate 3, periodic deposit. I'm putting $6,000 a year because it's easier, but really this would be $500 a month. But then I'd have to, change the periods to 360 and divide 3% by 12 and put in some weird percentage, and I just don't feel like doing that because I'm lazy. So it's a Sunday. It's lazy Sunday. So periodic deposit is $6,000 a year for 30 years at 3%. We're going to go ahead and hit calculate. It turns into $285,000. And just like I said before, if you could double your contribution, your periodic deposit from $6,000 to $12,000, I'll run it for you. Our 285 should be about twice that. It's 570. Surprise, surprise, surprise. So doubling the contribution doubles your account. But let me put it back to 6,000. 30 years, 3%, 6,000. We're at 285. Let's double the interest rate and see if we're at 570. Does double the interest rate to 6 do the same thing as double the contribution? Click calculate. Ooh, how interesting is this? We're at 474. Some of you might be thinking, wait a minute, I thought it was going to be higher than 570. And actually, to be candid, when I first ran this too, I went, wait, damn it, alarms were going off. I said, why didn't it go higher than 570? And then I remembered, we have to take into consideration that when you double your contribution, you're putting in a whole lot more money. So what we really want to look at here is how much interest was earned doing $6,000 a year at 3%, and how much interest was earned at $6,000 a year doing 6%. Because isn't it true that you're putting in $6,000 a year for 30 years in this scenario, in both scenarios? So 6,000 times 30, that's $180,000. Your total contribution is $180,000. Now, what happened when it was at 3%? What did it turn into? It turned into about 285, right? So I'm like, okay, how much interest did I earn? What did my money do for me? 285 minus 180, 105. So I made $105,000 of interest. Well, if I double the interest rate to 6, if you didn't understand compound interest, you might think, well, the interest I earned is going to be 210. I made 105,000 at 3%. You double the interest, I should make 100 and make 210, but that's not the way it works. I put it at 6%. We make 475 roughly. 475 minus the same 180 of contributions, because all we did was double the interest rate. I made $295,000 of interest instead of 210. Guys, that extra $85,000, which for some of you who are investing could be $850,000, that's the beauty of compound interest. And then what if I double it again to 9%? What if you could actually make 9%, like some index universal life insurance policies show a history over 27 years of making more than 9%? There's a policy out that has, compliance approved materials. So nobody choking their fettuccine. Compliance approved materials that show that over 95% of the 20-year periods we can measure, the thing made, I think it was over 9%. I can just show you the compliance materials. If you want them, email me, charlie@jewettwealth.com, CHARLIE @JEWETTwealth.com. And by the way, making 9% or 8% or even 5% inside of a tax-free cash value life insurance policy with very, very low fees is awesome sauce. And it's going to beat the pants off of anything like an IRA that you have to pay taxes on later, unless you can make 20 or 30% in that IRA. So can you imagine if we could make 9%? 30 years, 9%, you're putting in $500 a month or $6,000 a year, you're up to $817,000. $817,000, subtract the $180 that you put in, that's your $6,000 a year times 30, you made $637,000 of interest. Well, if you think of our first example, there was only $105,000 of interest at 3%. 105 times 3, 315. And this thing was at 600 something. Guys, compound interest is truly the eighth wonder of the world. It is what we are looking for, and you can't get it in stocks, bonds, and mutual funds. Remember, I carry a Series 65 license. I'm not some angry insurance guy. There's an episode coming out called I'm Not an Angry Man. I Just Play One on Television. I'm not anti-stocks. I'm anti-doing retirement planning with things that you can't plan anything on. Stocks are good at being fun. They're very exciting. And they're good at having crazy upside potential. So if you bought Apple, I don't know how many years ago, 10, 20 years ago, or Facebook when it first came out, then you're doing pretty well, and it was a lot of fun. That's not a retirement plan, because you could not have planned on that, because there's also people that bought Enron and are not having fun. Do you understand what I'm saying? So compound interest is what we're looking for. Now, here's another way to look at this. I'm going to set my future value calculator back to 6%, 30 years at 6%, $6,000 a year. Boom, we're supposed to be at $475,000 roughly. What if someone was charging you fees that entire time, like a joker broker, or your independent advisor, or your joker broker suggested mutual funds or a variable annuity or something that has a ton of hidden fees inside of it, to the tune of 2%, 3%, 4% on some variable annuities? Well, let's go to somebody who knows a lot more than I do, a guy that started a small company named Jack Bogle. I don't know if you guys have ever heard of this man named Jack Bogle, but Jack Bogle started Vanguard, which is Vanguard's famous for having low-cost index funds, so you don't have to pay these ridiculous fees. And let me just read something he says. Tallying the total expenses of an actively managed fund and compare, by the way, that's joker broker language, an actively managed fund. That's where you're paying somebody to gamble for you. What's traditionally called a financial advisor or a money manager. Somebody that says, yeah, let's spread you around a whole bunch of different crap and asset allocation and a little bit of this and a little bit of that. And we're worth our fees because you get a water bottle and we're on the 32nd floor of a 22-story building and all is well because my suit rocks. That whole model of let me gamble for you and guarantee nothing, so basically not give you a plan, is what Jack is talking about. Tallying the total expenses of an actively managed fund and comparing them to a passively managed index fund, Mr. Bogle has found that the lower cost funds have a 2.25%, guys, listen, 2.25% annual cost advantage. That means the joker broker costs 2.25% more than just buying the fund without him. He said in an email that in a stock market with 7% annual returns, by the way, this would have to be the false way, the compounding for this to work out this way, the returns of a fund with high total expenses would be reduced to 4.75%. Well, how'd you get that number, mathematician? 7% minus the 2.25 fees is 4.75 is what you're actually earning. Over 50 years, now what I'm presuming this is a working career of 30 or 40 years and then staying alive and leaving it in the market during your 10, 20, 30 years of retirement. Over 50 years, a $10,000 initial investment would grow to $100,000 rather than $290,000. So basically, 2.25%, and you get a third of what you're supposed to. 100 grand instead of 290. He wrote, at a cost of 0.06%, so less than 0.1%, easily obtainable in low-cost all-market index funds, the return would be 6.94%. That's just the 7% minus the 0.06. And the final value would be $286,000 in your account. So, ding, 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 ding. Hard question alert. If you put $10,000 somewhere making 7% for 50 years, especially if you had to live off of it, would you want to end up with 100 grand or $286,000? This stuff is not hard. Money managers and brokers, and particularly the giant mutual fund retail, but look into your portfolio, and if you have mutual funds, someone's probably ripping you off. It does not get more complicated than that. I can't get in trouble with compliance by saying that, because there's articles all over the internet on the costs inside of mutual funds and how there's not worth it. There's articles everywhere on how money managers don't beat the market, and yet, after reviewing over 1,000 financial plans, almost every single one of you come in and someone has spread you around a bunch of mutual funds. That's because this industry needs to be crushed and knocked down and built up from scratch, because it's built completely on immorality and ignorance. Whether they know they're doing it or they're doing it by mistake, it doesn't matter. It still hurts you just as much, and we need to fix it, and my team can fix it. Get in touch. Charlie@JewettWealth.com. CHARLIE at JEWETTWealth.com, or you can call us 888-285-2268. So let me go back to the calculator and just do this. So 30 years, 6%, $6,000 a year. We're supposed to end up with $475,000, right? I don't know. What if there's a 2.25% fee because you're in mutual funds, or you're trying to have some guy gamble for you instead of just buying Vanguard's funds? I'm just going to lower that 6% by 2.25. So what would we be at? 3.75%, right? So making 3.75, which is your net. So even if they were, what I'm saying is they could be making you the 6%. But if you're in the wrong model, which is a money manager who's using mutual funds, you might only be compounding at 3.75 because of the fees. I'm going to hit calculate. Instead of $475,000, you have $322,000. Now, if that doesn't shock you, if you're not like, boo, that's terrible, let's just take 475 minus 322. So you have 153 grand less than you're supposed to. Divided into the 475, you lost 32% of your retirement to fees. 32% to fees. I don't like that. I don't think you should pay fees unless they're worth it, unless they're buying you something like the avoidance of taxes. That's cash value life insurance, or guaranteed income for life, even when you run out of money. You will never find a broker anywhere in this country. If you take any of the Edward Morgan Lynch's or any of the smaller ones, you will never find a single one of them who will say to you, put your money in stocks, bonds, and mutual funds, and if you run out of money, I will pay your family, you and your wife, all the money you needed to pay your bills until you both die, and I'll do it happily. But you will find insurance companies who will, if they can charge you a 1% fee. I don't think you should pay fees unless you're getting something worth it. Gambling and underperforming the market is certainly not worth paying fees. Does that make sense to you? Have I beat that horse enough over these podcasts? Now, let me talk about something I've talked about in the past, but point you to a picture. So if you go to charliespictures.com, CHARLIES, Charlie's Pictures with an S.com, you find my Instagram page. If you can't find it that way, just type Charlie Jewett Instagram and hit, in Google, put Charlie Jewett Instagram, you'll find it. When you get there, you can avoid the online dating pictures. Oh boy, I looked handsome back then. I was a little bit thinner. I got some work to do. Whatevs. So you click on this thing I just put there called 2020 Vision. You'll see this thing in red letters. It says 2020 Vision on the top. And I learned this from Len Rainier from the Wealth and Wisdom Institute. Incredible teacher, awesome man, love him to death. He taught me this, which I call the most important thing you could ever know about money. And it has to do with what we're talking about. That same thing with the 8% earned different ways, but we're going to do it with 20%. I promised I'd show you. You could earn killer percentages and run out of money. So here's 4 different ways that you could be averaging 20% per year or 20% per day or however you want to do it. The top one, you're going to see, if you look in the middle, the left-hand side shows your account value, the right-hand side shows the average. Let's look in the middle. The first year you make 20%. That's nice. The second year you make another 20%. That's the true compounding interest. Well, if you put $1,000 in, you made 20, and then you made 20, what's your account worth? Always $1,440. And my problem with the industry, the reason that I'm standing up for you guys and fighting the bad guys, is because most of the retirement planning software, all of the ones I've ever seen, I haven't reviewed every software on the planet, all of the software I've seen and all the financial statements use that number to calculate your future account value. They say, oh, it's going to be compounding steadily as a compound annual growth rate at this average rate of return. So if you put in 1,000, make 20%, then 20%, you should have 1,440. But what happens if the first year is awesome and there's a small correction? The first year goes up 60%. And then you have a small correction of 20. Well, what are you averaging over the 2 years? I don't know. Let's go back to 5th grade math. I have an episode called Is Your Advisor Smarter Than a 5th Grader? That the entire episode is about this. I give tons of examples. Up 60%, that's positive. Down 20, that's negative. Add them together. Positive 60 minus 20 is 40. Divided by 2 is 20%. We're still averaging 20, but what's the account value? If you let that happen, 1,000 goes up to 1,600, and then you lose 20% of that bigger number. your account's only at 1280, 1,280 instead of 1,440. That may not sound like a lot to you, but if you're talking 1.4 million versus 1.2 million, that's a lot of money. And as a percentage, it's quite a lot of money. Well, look at the next one. Here's why so many people are having trouble retiring with so much less than they expected. Goes up 100%. Your $1,000 turns into $2,000 in the first year, and you're like, yeah, baby, that's why I never listened to Charlie Jewett telling me to use index things where they got a cap on them. They got a ceiling, boy. You can't make that 100%. Somebody's going to give you a haircut. They get all excited, say, oh, this is why I use the stock market, boy. Goes up 100, then has a correction, goes down 60. So 2,000 or 1,000 goes to 2,000. You lose 60% of 2,000. You're down to $800. Started with 1,000. You're down to $800. Every human being in the world, besides joker brokers, would agree that's a loss of 20%. You had 1,000, now you have 800. But what are you averaging? What are you averaging over the 2 years? What are they allowed to show you? You're averaging 20%, of course, because positive 100 minus 60, that's 40% divided by 2 years. That's 20% average. Man, now I see what he's talking about. This is crazy. And my favorite, you go to Las Vegas, you're up 140% in the first day, baby. Yeah, yeah, yeah. Like all good people, when you're up 140% in Vegas, you cut your trip early and you go home with your winnings. Isn't that what you do? Nope. That's not what anybody does. They get greedy, they get arrogant, and they stay too long and lose 100% of it sometimes. So you're up 140%, then you lose 100% of all your money. But guys, in any year, if you have 100% loss, what's your account value at? 0. And in this case, 0 is not your hero. So your account value is at 0. But what did you average over your 2 days in Las Vegas? Positive 140 minus 100 divided by 2 days, 20% per day. You're living on the streets out of a van, eating food out of the trash can, and as people walk by, you should say, you should see my portfolio. I'm making 20% a day, baby! Because it's a farce. Average rate of return has always been a farce. Everybody knows it's a farce. They hide it from you on purpose. It doesn't have much life left in it. It's going to be gone at some point here, especially if you guys vote with your money, leave your brokers, and switch over to honest advisors who are going to give you real rate of return, because it's the only thing that you could ever build a retirement plan on anyway. This isn't called retirement gambling. It's retirement planning, for heaven's sakes. Another thing I want to talk about as far as accumulation is that there's a decision to make, and we've been talking about the stock market and taking losses. There's a decision to make with how you want to approach losses and bear markets, okay? We need bear markets. There have to be bear markets, I believe. Let me go back on my Instagram. I believe I've posted some things on here about bear markets. I don't see it now, so I'll have to post it. There, decision made. I have to put up the bear markets, how many bear markets they've been, how long they last on average. I did a podcast on this called The Bear Necessities. The Bear Necessities. You like that? And there has to be bear markets, okay? But you can choose to participate or not participate, and you can choose how much you participate. Most people don't know this, that losses have been optional for 20 or 30 years. The 3 approaches to bear markets and losing money are these. You could take all of the ups and all of the downs. And that's what financial advisors want you to do, because it's the most lucrative lifestyle for them. This is where you buy stocks, bonds, and mutual funds, your basic just portfolio, like many of you still have. Why haven't you called 888-285-2268? I don't know. I don't know. Many of you still have this. All of the ups, all of the downs, that whole strategy for the last 18 years, before fees, has made like 4.5%, 5%. It's disgusting. And if you're not getting the dividends, it's even lower than that before your fees. So that's one way to handle retirement, is to go, I have no idea what I'm going to end up with. I will take all of the risk. I'll pay all the fees. My broker gets paid no matter what I end up with, and we'll just see how it works out when I'm 62 and 65 and my body hurts so bad I couldn't work if I wanted to. And you just roll the dice. Well, I certainly don't suggest that one. If the market paid you 15% on average, compounding, for doing that, I would. but with it paying 3 to 5, depending on how people what funds they're buying over the last 18 years, I wouldn't. Well, there's another one in the middle, probably the least popular, some of the ups and some of the downs. Now, the only place I've seen this is inside of variable annuities, and so I don't use this strategy because I don't like variable annuities not that much. It has nothing to do with the concept. I think it's a great concept. It's just that you could buy those same mutual funds and everything outside of the annuity, and you have more choices than the annuity gives you. But most importantly, the annuity adds 2 to 4% fees, which will crush your portfolio from the math we just looked at, unless somehow the actual sub-accounts you're in, which are kind of like mutual funds, the sub-accounts just make 20% a year for the next 30 years, then it's going to crush everything else. But they don't. Historically, variable annuities have had some good years, while the market was also doing well without them. So you probably didn't need them then either. The fees are too high, period. The fees are too high. Listen to my episode, 6 Types of Annuities and How to Use Each One for more information on that. But there's some variable annuities that do some interesting things like, hey, if the market goes down, we're going to limit you to the first 10% or the first 20%. You sort of pick a loss trigger where it stops, and then for that you take a haircut on the upside. I don't know what it is because I'm not in that. I don't like working with variable annuities, so I don't know them that. I don't know the details of the different products that well. But it might be something like market goes down, you can only lose up to 20. So therefore, when the market goes up, you only get half of the ups or something like that. What I am very familiar with, I've spent a ton of my time in the last 14 years working with, because it has lower fees, it's safer, and it makes more in the stock market, are some of the ups, none of the downs. And I know 100% for sure that this picture is on Instagram. So if you're on Instagram looking at the 2020 vision picture, scroll down and you will find there's a colorful rainbow looking thing next to one of my dating pictures. What's up, handsome? It's red, yellow, green, some other color, and then blue going across. There's this 5-column thing. It says market has lower returns than annuities, and this before the next crash. You just click on that and you can see me comparing the market to something where you have no losses, but when the market goes up you get 50% of the gains. That's called a 50% participation rate. If you don't know about participation rates and caps, you can listen to the episode called Talk Nerdy to Me. It was bad the first time I did it, worse the second time. Back to the information. So some of the ups where you get the first 11%, or you get 40% of whatever it does, or you get everything after the first 3%, which is called a spread or a margin, those strategies have beat the pants off of the stock market over the last 18 years, and no one can argue it, and no one will even try after 2.5 years of begging advisors to debate me. So you're just going to have to take my word for that, or get in touch and we'll just show it to you. It's not something we're saying. It comes on company material. Whatever investment company or insurance company has the product has all the back testing and all the compliance materials, the compliance approved materials to say, here's what this thing would have done if you bought it 20 years ago or 10 years ago or whatever. Enough about that. 3 ways to approach losses. You can either take all of them, you can take some of them, or you can just get completely out of the loss game like I have. I'm 46. I don't have a single dollar in the stock market because it's more risk and less reward than all the other options. So I don't play that game. You can do what I've done and just divorce losses. Say, I don't want to lose money anymore. I want true compound rate of return. I want my money growing upon growing upon growing. If you had a whole bunch of sheep that had babies, and that's how you created your wealth, how many plagues do you really want to have? Because you're like, well, somehow, when a plague comes along, it sort of kills the weak ones, and then the strong ones, they multiply some more, and then eventually, like 8 years later, I got more than I started with, and I like it that way. Who would ever want that? If you have a whole bunch of sheep, you're like, I want them all having babies. Like, I really want all these sheep to have babies, so next year I got more sheep, and next year I got more sheep, and more sheep. You just want it to grow. Not this weird up and down like plague versus like birthing explosion, plague, birthing explosion, especially if you end up with less sheep that way, which is what the stock market has been doing for the last 18 years. Is it worth it to pay a money manager? 100% no. I mentioned this earlier in the episode. What should you really be paying for? You should be paying for things that you know that you want and are proven to have worked. Paying for a guaranteed paycheck. Absolutely. Paying for tax-free income. So you're paying a fee instead of paying taxes for 30 or 40 years of your retirement life. Absolutely. Paying for somebody to create a trust for you. Probably a good idea. Paying for great tax advice. Amen to that. Paying for somebody to gamble for you when their fees are higher and their performance is worse than not using them 80 or 90% of the time across the entire country? Nah, not a good idea. You guys are better than that. How do I know that? Because you people are the best.
Renovating Retirement with Charlie Jewett.
That's all, folks.